Hey guys, while we're waiting on Kashop, we're just going to get started. There's so much to talk about today, and one of the things to talk about is gold. We talked about it the other week. Are we looking at this trade to be over? Is gold over? Is it the end of gold? And the answer that we gave was no. Kashop came on here, had a really great take on that. Sam had a good take on it. And I also looked at it as well and said the same thing like, hey, it's not over. If we look back at when it hit the 200, for example, GDX hit the 200-day moving average. And let's bring a chart of that up because that's an easy thing to look at. And most of the time, you're not going to see a ton of buyable dips. It's a very hard thing to do in commodities land. But gold, you can actually buy the dips. It is a mean reverting product. And if you look here, at GDX, pulling right back. This is a 40-week moving average or the 200-day moving average. It pulled right back to the 200-day moving average. It bounced off of that moving average and then started to move higher. And we picked a bunch of names on it. We also put out an alert on Monday for our group on Substack. So if you guys are on YouTube, go to the description link. You can find us. We're at AAO Research on YouTube. Definitely click on that. You guys can be subscribed to it. It was a free report. Put one out on Monday. That's basically market catalysts and trades you should start to pay attention to and what's going on for economic data, earnings, and so on. So you get that all to your inbox at 8 in the morning or 8 to 9 in the morning on Mondays, Eastern time. But if we're looking at GDX, I'm really looking at this bounce to hold up here. I think too many people are getting too bearish on it. And if you look at the seasonality too, gold mining seasonality is actually really good into year end, especially into January. January actually looks really good. And especially, if we have this situation with our chair, which could be
The president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
You know what? I'm not leaving. I'm not leaving. I'm not fucking leaving!
So Jay Powell, that to me was funny. Kevin Muir ended up posting that the other day. I asked him if I could share it on here. He said yes. So I was glad to Kevin for that. He's on the Macro Tourist. You guys can check him out as well. But I thought that was hilarious. Powell coming out there and saying that was just total Jeremy Powell, like we've always known him to be. Not a big fan of the Fed. It's kind of funny, but I do like that he just said no and just left it at that. What's up, Kashop? How are you today?
Hey, Jason. I'm good. How are you?
Good. So we were talking about gold and where we're at in the gold market and seeing this bounce. And I just brought up this chart, which was the basically gold bouncing off of the 200-day moving average and then reversing higher. So basically it got to that level around, that'd be at 35, between 35, 36. It bounced up higher. What are you looking in the gold space right now? I know you've been talking about some miners. Are there any names you can think of that you like, things people should be paying attention to?
Sure. So this is the tax loss season, so it's heating up. So what that means is you have institutions selling a lot of their losing positions in order to book the loss by year end, and then there's a wash trading rule. So what they do is they have to wait 45 days in order to buy it back. So this is the period where any stock that's down on the year kind of tends to get hit regardless of the fundamentals. So it's not just in the gold space, you can also see it in the oil space. It's happening like a stock like More Drilling, which is just going straight down. IM Gold, not IM Gold, sorry, IAT Gold, when they announced they're going to have a little bit of trouble with their debt, just went straight down. So you have these kind of big sell offs happening at this time. So what I'm looking to do is, so I'm active in this season in particular. I'm very, very active in the small caps. So the stocks that are at the 50 to 100 million market cap range or even lower. And these are stocks that I know very well because I've been a gold mining analyst since 2016. So I know the space extremely well. So what I do is when I see indiscriminate selling just because of the tax loss season effect, I go in and take a position. Now, does that mean that you can just take 5-10% positions in each of these stocks? No, you can't because they carry a ton of risk. So what I do is, so last year during tax loss season, I had a portfolio of 90 junior mining stocks, which were all in the small cap range. And then as January, February kicked off, I sold them for a good gain. So the overall portfolio, I haven't done the math, but I'm guessing would have been up around 20 to 30% just by holding for these 4 month duration. So I keep doing this. Of course, not every year presents that opportunity. This year in particular is rife with that opportunity, mainly because a lot of stocks ran up quite a bit when gold was running up and everyone was getting excited, and then they're kind of gone nowhere. So what happens is everyone who is late to the rally takes the tax loss now. Everyone who is early to the rally is still sitting on tremendous year-to-date gains, but everyone who is late is sitting on losses. So you have the situation where just because the stock had this big up move and then kind of like sideways, you see a lot of selling. So these are the good stocks which I can confidently take, say, 2-3% positions. And so I'm just building a portfolio of those stocks. Now I can give you names, but then the caveat here would be these are all really small cap names. So I would just say run a screen if you find projects in jurisdictions that you like. For instance, if you find good small caps in Canada and let's say they have a 5 million ounce resource and the market is valuing it at $25 an ounce, you probably should be buying it. Now, let's say you have the same project, the same economics, but it's in Venezuela, you probably shouldn't be buying it, right? So that's how you differentiate it. But let's say you find something in Canada which is trading at $25 an ounce and something in Burkina Faso which is at $10 an ounce, then that's probably worth looking at. So it's a niche field, but I'm not looking at the large caps right now. In fact, I have actually sold all the large caps that I own except IM Gold. And that's just because IM Gold is so undervalued that I can't bring myself to sell it. So I've sold all the large caps. This is the season where I'll focus on the small caps, and come Feb, when I harvest this capital is when I'll move back to the large caps again. So I know we have very different philosophies here. You trade the sectors and the ETFs, and I trade the small caps. So
Well,
I'll
actually,
try to.
on this, we're very aligned on this one. I was actually going to. I just made a post about this very recently. Moving into, I'm trying to bring it up here if I can find it, but basically moving into these small cap areas and the micro cap areas in the gold miners, silver miners, even being a primary focus, and even building my own ETF because I don't like a lot of the like SILJ. I'm not a big fan of that ETF at all. So I'm basically picking names that I am interested in. So I'm very aligned with you on this. And it's also, it says a lot too that you're going through the microcaps because this is small cap, micro cap season. And what that means is most of the time when if you're just seasonality, and once again, seasonality isn't something you can just trade off of and make a ton of money all the time. Seasonality is it's a tool to basically kind of look at things and go, for me at least, I look at it and go, okay, the flows could be heavy at this time. I might catch some major trends around these times. And for me, I also notice most of my returns, because returns are lumpy. You go through periods of choppiness, whatever system strategy you use. If you're a trend trader, most of the time your returns are big towards year end and into the beginning of next year. So basically November through April. And what we see too is that small cap season. So most of the time, small caps, micro caps, some of these smaller areas start to get more money flowing into them. We see breadth widening out. That's very normal here. So I really like that idea of kind of digging into some of these smaller areas. So, just not to give out, I know you give a bunch of names on your own newsletter, so don't give out a ton of them, but maybe just stick to one name, maybe something that's in a larger market cap, something that's not like too small, not an explorer per se, maybe a junior, anything that you're thinking is looking good out there? Because I'm with you. I've moved on to the smaller areas in that market. I think there's a lot more opportunity there.
Sure. So I am gold as a stock. Full disclosure, I've been holding it since the $3.9 range when it had that big gap up, potential flag pattern. So that's when I bought in, and I've been holding it since. I think it's still undervalued. So they got a new mine online in Canada earlier this year, and the market hasn't fully given them the value of that mine. So my estimate at a $2,000 gold price, that mine is worth probably around 2 billion plus, and it's much more now at 2,600 and rising gold prices because it's uh, so it was a very tough mine for them to bring on because the grades were low, and because of capex inflation, labor inflation, they were forced to find a joint venture partner, farm out a bit of it, and finally, after a big struggle, they got it online. And then, right after they got it online, gold prices took off. So, after all that struggle, this is when they are in the payoff mode. But market still remembers them as a struggling gold producer. So, IM Gold is one, and they have two other mines. Both of them are so-so assets, but they're still worth far more than what the market is valuing them at. And if we go into the explorer space, so my favorite here is Kina Resources. That's SKE. And I met with the management. I was at a mining conference this week, like last 3 days. So I met with the management and very impressed with their stories, something I've been following since 2019. So they are building a gold mine. They are fully financed. In fact, they are over financed to build a gold mine in British Columbia. Now, a company being over financed to build a mine, it's a first in the mining industry, and they are the ones to do it. And that's because the chairman, he has his background in the capital markets. He knows how to tap the high yield market. So he's done a tremendous deal. It's a fantastic asset. And I think once it becomes a mine, it's just going to be a cash crusher. And this is the right deal to do it. So the stock has run up something like 90% this year. And when I first bought in, I thought it had like 4x upside. So maybe right now it's 2x upside. And but it's 2x upside plus whatever you get as the gold price goes up. So uh, the math here is a little different. So it's not like gold goes from 2,600 to 2,700, which is like, let's say, a 5% move. The stock has only 5% more upside. It's more like the entire $100 per ounce. If you're producing 100,000 ounces a year, that entire amount falls straight to your bottom line. So if gold goes up $100 an ounce and you're producing 100,000 ounces, then 100,000 ounces into the gold price. So that's like $10 million that goes straight to your bottom line just from the higher gold price. Now, if you're a $1 billion company, that 10 million represents 1%. So then you have 1% upside. But if you're a $500 million market cap company, then that's a bigger upside. Now, as the gold price keeps going up, what happens is the kind of gains you make, or the profit that you make, increases in proportion to what your costs are, what your production is. And so the upside is not exactly linear. It's some type of a multiple of the gold price. Now, if you find something like Skina, which is pretty high grade, the upside can be tremendous in a rising gold price environment. And especially because in a rising gold price environment, what also happens is, so we all think, there's gold in the ground and, the miner just brings it up and that's all there is to it. But that's not the case at all. So when I call some mine, there's a 5 million ounce gold deposit here and they're mining it. That 5 million ounces, the ounces are calculated at a particular gold price because the deposit can be mined. It's only economic if the gold price is at a particular level. So now when the gold price assumption used in modeling that deposit, let's say it's $2,000 an ounce, a lot of very mineable gold, which requires some waste material to go through or requires some additional investment, that will be left out of the reserve calculation. But when the gold price increases, that stuff becomes economic to mine as well. So then that gets bought into the deposit. And when the gold price increases, you can go deeper. And typically, what happens with underground deposits is when you go deeper, you find even more high grade gold. So then that stuff becomes lucrative to mine. So the rising gold price gives you all kinds of optionality when you buy the miners. And it's not just linear, it's not just based on their costs and what they are producing. It's also about what kind of deposit they have and a whole host of other things. So what I like to do is I kind of have a feel for all these metrics. So what I like to do is I look at the share price. So for me, everything starts with the share price. I constantly monitor. I have a big watch list. So I have a watch list on StockWatch, which lets me watch 600 stocks for the fundamentals. And I have the same kind similar watch list on Interactive Brokers, where I look at the charts and basically just look at the price changes. And when something catches my attention, then I look deeper. So what this gives me is tremendous breadth. So when I find something that's just selling off for no reason and I know the asset, I don't really have to do too much work in order to buy a stake because I already have done most of the work before the move happens. So this lets me take decent sized positions in stocks where a lot of people might be scared because hey, it's falling, something must be wrong. But if you look at the way small caps move, it's very, very normal to have that kind of volatility. For instance, you could have a small cap going straight down for 10 days for no reason except a fund which owns it is now shutting down and they are selling into the market. Or because you brought up the silver miner ETF. So here's a funny thing there. There's a stock called Generation Mining, which has a pretty big allocation in the silver mining ETF. Now, what does Generation Mining do? They have no silver. It's a platinum palladium deposit, but it's there in the silver mining ETF. Now, what were the ETF guys thinking? We'll never know. But they just went ahead and put that in anyway. So
There's a ton
you
of
have
that in
these.
a lot of the smaller. It's hard because as an ETF guy, because for me it's just a very simple way to get the diversification that I'm looking for. But there's a lot of ETFs out there that are just garbage, and so that's something that you kind of have to be aware of. Even if you're trading it, there will be times where I might be long something that I think is garbage, but there's a reason why. I'm just saying for people, it's better to go inside of it, look what it is before you just buy it. I mean, even things like DBA, there's a lot of short-term treasuries in it at times. Not that I'm against that, in certain environments, it makes sense. But once again, you're thinking you're just getting exposure to these agricultural commodities in the DBA ETF, but there's a lot of other things in there as well. So once again, just continue to look at what's inside of these ETFs. Easy way to do it is just put the ETF name and then ETF holdings. And if you just put that into Google, most of the time it'll come up. Koifin makes it real easy. I think even if you have a free account, it's really easy to just go on there and type it in and it'll come up and you can see what's inside of it. But going through what's inside of it and then figuring out maybe I like this, maybe I don't like this, finding the names that are outside of the ETF, like this is a lot of ideas that you guys can take home with you and possibly do for yourself. And as I was talking to Kashop earlier, you guys will probably have to pause this to bring this up, but I was actually posted this the other day, which is talking about the buyable dip in gold. But also, I thought it was interesting because for me, this is something I don't do much, which is talking about the ETF, what's inside of it, and saying, I'm not going to buy the ETF. I actually plan to buy some individual names. So, for you guys who are subscribed, go through there, check it out. Try to figure out what you guys would like to do inside of there. And I'm not even saying when I'm going inside of it, hey, pick the same things I am picking. Or even in the sector, pick the same things I'm picking in the sector, because there's certain things in the gold mining portfolio for me that Kashop has told me about and different names. It's figuring out what works for you, the type of names that you want. And also, if you don't want to own small cap gold miners, which there's nothing wrong with that, just don't do it. Go buy something else.
Yeah.
You could do that as well.
But
So another thing,
if you are buying the small cap gold miners, I would say please avoid the ETF because you throw in a bunch of great companies and a bunch of garbage together and you more or less equal weight them and you stick them in an ETF. That trade is never going to work because the garbage will just pull the winners down. The overall returns are going to be crappy, and because these ETFs actually churn quite a bit. Like
Mhm.
SPY ETF churns maybe twice a year or something, but these
Mhm.
ETFs are not built that way. They churn quite a bit, and the trading activity they generate actually works against your returns because when you know the big ETF. So, for instance, let's say generation mining. Now, let's say the silver ETF decides we shouldn't hold a platinum palladium exploration company in a silver ETF, and they sell it. What do you think happens to the stock price? It just crashes, and they're going to keep selling into that crash because that's how they're programmed to sell. So they just keep getting a worse and worse price. And same way on the way up when they are buying. So let's say Endeavor Silver, they just announced a big financing. Their market cap is going up, so they wait and the ETF is going to go up. So what happens then? So you buy the spike. So these ETFs actually end up with terrible execution on both ways, which actually takes a lot of value away from it. Now, if this is something like if this is something you're going to hold for 10 years, 15 years, then this is irrelevant. So let's say you're buying this SPY ETF for the all country world index or something like that. You're probably buying it in a retirement account. And it doesn't really matter if you're buying it on the first of every month when everyone else is allocating, or you're buying it on the 25th or something. Maybe you have like 10, 20 basis points of performance difference if you are timing your buy. But for these ETFs, given their churn and the fact that you're really not going to hold it for too long, you're just going to hold it until the end of the bull market in the precious metals, those costs actually start to matter.
You also run into a lot of people who, one, this question comes up to me a lot, and I think it's actually it's misguided question, especially nowadays where everything's you can buy things in fractions of shares and so on. Like that wasn't a thing back in the day. So the thing that comes up a lot is, okay, you guys are making some sense. The SIL ETF, maybe I won't buy that. Maybe I'll look inside of it, find some names that are good. Then they would say, well, I don't have the amount of money to really do that. And to that, I say, like, once again, if you're going to buy the SIL ETF, you're owning, it's kind of like when somebody buys the S&P 500, you're owning 500 names. They're all at different weights. Take out the ones you don't like, make the weight the same. If you need to make it the same amount that, like, let's say the S&P 500 ETF is $100, I know it's not, but just to make it easy, SPY is $100. And then you're going to buy, let's say you're not going to buy all 500, you're going to buy 10 stocks inside of there. You go in and you just take that $100 and you cut that into fractions and you do $10 a piece. And then once again, you have basically the same idea as the ETF, but diversified in an equal way. So there's a bunch of different ways to do it. You could do it market cap way. You could do it a bunch of different ways, but I'm mainly saying, like, that diversification of owning, like Kashap, better than me. If you were to buy one, if you just put it all on black, you were like, okay, I'm going to buy this one miner here and I know it's going to work. Like, is that a good idea or is that a recipe for disaster?
I think if you buy the royalty companies, you might be fine if you do it that way. So if you buy Royal Gold and you're like, I'm just going to let it, in fact, you can buy it in your retirement account and just let it
Well,
be.
I'm just saying one in your
Yeah.
entire retirement account, not the royalty companies. I'm talking about the small
Oh
caps.
no, that's a disaster.
Yeah.
That's bound to be a disaster. You
Yeah.
may make money in the first year or something, and then something happens, and then you're going to lose it all. And I'll tell you the worst part of it. The worst part of it is that if you make money this way, then you grow confident that you can make money this way, that you can take those big bets and those will work. Now, what that does is it gives you a very false level of confidence because what worked at one point, the math is against you. You keep doing it over and over, you're going to blow up. Like, let's say you're not at top and you think you have a system to beat roulette, and you get lucky once, you get lucky twice, you make a bigger bet, and then you blow up because you never really had a system after all. And it is just impossible to pick one stock and know for sure that it's going to make you rich because it's mining after all. Like, let's say the one stock that you pick happens to be the excellent miner, geopolitically diversified, everything, and then something happens. And let's say some issue crops up at one mine in one locality, and then it has a snowball effect. For instance, a tailings dam fails in one location, and suddenly every government is like, hey, are these guys good operators, or should we check their tailing dams everywhere? And then they revoke their permit, or they add extra costs onto them. Or let's take the case of SSR mining. So they were pretty diversified, but they had a big asset in Turkey. And unfortunately for them, Turkey had an earthquake. 11 employees went under, and it was pretty gruesome for them. And the government cracked down on the company because they said you didn't construct a leach pad well. So you can have a situation like that. Or the issue that Goldcorp used to face, which is why they had to be sold to Newmont. Their biggest mine in Mexico saw one labor action after the other, just because they were the biggest. They were the ones on which the unions could make a statement. So a situation like that crops up and then you're done. Or even worse, if you buy a single mine company like Victoria Gold, what happened with them was they are way up in the Yukon, so they cannot really run the mine year around. So what they do is they used to stack the ore only when the conditions were right, meaning the dead of winter they would just completely shut everything down. And then they decided that what, we're not able to meet our numbers and the market expects better results. So let's just start stacking the ore year around. And because they did that under terrible weather conditions, they had a spell. And that was the end of the story. So if you're buying a miner, you definitely cannot buy just one or the other. You have to buy a basket, and you have to know, it's like when you sell options. When you sell options, you know for sure that 99% of those trades will make money. And you also know that one of those will end up in a complete disaster, which takes out 10-20% of your accumulated PNL. And that's just a risk you take because you're a wholesaler. And it's the same risk that you take when you're buying the miners. So you have to buy a basket. You will get tremendous gains, and every once in a while, you will get punched in the face. So you just have to be prepared for that and roll with it. So that's what I do. And what I try to do is when I get punched in the face, I try not to make it worse by adding more capital to that particular name. Now you might be tempted, oh, this is a bigger bargain. Now, these issues will be solved. And maybe you're right, maybe you're not. But if you don't control your risk, then one of those disastrous trades can just take down your P&L for the entire year. Just like selling options. And there's a reason no one sells naked puts anymore, because you know the risk. And it's the same way with buying these mining stocks.
I like the Edward Thorpe quote, or not Edward Thorpe, Ed Seykota quote, where he talks about, if you're not willing to take a small risk, you're going to take the mother of all risks at some point, and or the mother of all losses at some point. And it's true, because if you look at the market and you just go, okay, well, I know what I'm doing. When you're a new trader, you think you know a lot of shit, and the market goes down, and you think it, like you said, it's getting cheaper, so therefore cheaper, better bargain. And what I always say, and it's a something I always think about, which is human psychology in real life compared to the market. If we're looking at real life, like, yeah, bargains look great. You go to the grocery store, you don't ask, hey, I want to buy bananas because they're breaking out to the upside. They've been at $3 for the last 5 years. Now they're at 301. I want to buy bananas. Like, you would never do that. However, in markets, it's price levels have memory. And not to mention, when people are interested in things, the price of things continue to go higher. That interest will drive things, and the relative strength drives things, and capital flows, and all these things, they drive prices higher. It's kind of like, it sounds crazy to buy, back in the day when you and I were just met, we were buying Bitcoin, and it crossed $1,000, and it sounded insane to people. Okay, it's $1,000. This thing isn't even real. People are going to buy it. That sounds crazy. And then really it's like, now it's almost 100K. Like it just, no crap. Like it made a lot of sense to buy at that time. But once again, it's a very different thing. So it's very hard to let go of your old biases of like, I'm trying to buy low and sell high. That's what honestly a lot of analysts market as. I was looking at this the other day. I was just looking at other analysts, seeing what they were doing and so on. And I was like, every single person, their mantra is buy low, sell high, because that's what people identify with. And it's not that you have to buy like at its lowest or buy at its highest to buy high and sell higher. It's that finding that strategy that works for you is important. How do you find a strategy that works for you so you can just buy at these levels like we're talking about and do what you're talking about there, which is getting rid of those positions as they're going against you? I think that's the hardest thing to do, to let go of it as you start as a trader. You really like oil. You think oil's cheap here. You continue to buy it. I see it all the time with new traders I'll talk to. They'll be like, "Oh, it's a bargain." Natural gas was crashing 3 years ago from $10 all the way to 2, and everybody's going, "Oh, this bargain's great. This is a great bargain. I can continue make a lot of money buying natural gas. I'm gonna sell it when it gets up to $10 again." And they're buying it at $6. They're buying it at 5. They're buying it at 3. They're buying it at 2. And then at 2, they go, well, you know what? This isn't working out, and they sell everything. And that's honestly how traders work out most of the time, or investors or new traders or people who aren't very experienced in the markets. Is that's what they do. They buy on the way down, they sell at the perfect bottom, and then you'd be better off just waiting for some momentum to get behind it and buy it a little bit on the way up. I like how you talked about the trade you were doing earlier. I think it was IAG, where you bought out of the flag pattern. Just putting it at, it's not even that technicals are perfect. It's that they just let you understand the risk to reward of the chart. So the risk to reward is here. This is where my stop loss is. This is where I'd get out. This is where the trend changes. I don't know if it's not that it's magic. It just is a way to identify your risk and manage your risk. And I think that's really where charts are essential, because I don't know how else to manage your risk without looking at a chart. So I mainly just saying, I love what you said about on the way down. Like don't continue to buy more on the way down because you think it's a bargain. So let's jump into the next part, which is I want to talk to you about the dollar, and then we'll get into interest rates. So the dollar here, I've been adamant on we're hitting the top of the range. We should see some downside. I've been very wrong on that so far. It broke out a little bit to the upside, but where I've been right is all these other assets have continued to move, which is very odd. And for me, it's not that one has to go up and the other has to go down. For example, something like Bitcoin and the dollar going up at the same time. I'm not saying that that's impossible. I'm not saying that you sell positions based on what the dollar's doing. I am saying that something's going to give at some point, and it's either the dollar or assets. So what are you thinking about the dollar here? You could tie it into interest rates, however you want to do. I brought some charts on interest rates as well.
Sure. So I think the dollar's tremendously overvalued here, and that is just in isolation. So forget about rates, forget about where equities are at, forget about every single other macro factor, oil, Bitcoin, gold, everything else. Just looking at the dollar and all the FX crosses which go into the dollar index. So just looking at the dollar and all the FX crosses, I think the dollar is tremendously overvalued. Now, does that mean we get a trend change? I don't know. But at least we are going to get a mean reversion. The dollar is not going to be going straight up. It's not going to be able to repeat this flag, the kind of insane move that we have seen. That's not going to last. And why do I say that? It's because currencies are the most fundamental of all trades. Now, what happened when the yen weakened? When the yen weakened, everyone just booked a trip to Japan to go buy their Louis Vuittons and enjoy the cheap currency. So when what you're paying in dollars or euros was extremely cheap compared to the experience you could get elsewhere. Now, what that does is you're sending an inflow of USD into Japan, and what that does is it kind of strengthens the yen a little bit. Now, multiply this effect over every currency, over every trade, and it is not just tourism. It's, for instance, let's say you want to buy something that's made in the USA and it's a good product and it's at a competitive price. The dollar strengthens a lot. So what do? You just go look for a cheap Chinese product or some other, maybe a European product, and you stop buying the American product. Now, what that does is the demand for the dollars, which would have come and fed into the American economy, that no longer exists. So what happens? The dollar weakens. Now you just multiply this by every trade, every decision that people take, and these are real business decisions taken by real people or business, leisure, whichever way. So what happens is when currencies get lopsided, something or the other changes. Now, the best example I can think of for this is the 2011 bull market in commodities. The Brazilian real got so strong with respect to the dollar that Brazilians preferred vacationing in Miami over other places in their own country. Now, this has happened earlier with India and Sri Lanka. 2007, the Sri Lankan rupee was so strong and the Indian rupee was so weak in comparison that they would rather come do all their purchases, vacationing, they trade everything in India rather than back home, just because they could take advantage of the strong currency. So when you see the dollar moving up like this, what happens is people start moving out of dollars and into other economies. For instance, everyone talks about how cheap Japanese banks are. Japanese banks have always been cheap, but maybe when the dollar is this strong, is that the time to rotate out of the dollar and into Japan? And everyone knows that Trump tariffs, everything is going to hit China, but manufacturing is not going to be able to move away from Asia because that's where you have the labor and the factories and the capital. So is this trend going to benefit Vietnam and Thailand? And should you take advantage of the stronger dollar and invest in Vietnam and Thailand? So when the allocators, when people start asking questions like this, the moves in the currencies tend to solve themselves, which is why I think this kind of straight up move in the dollar. So there's just one scenario where the dollar can keep running like this, and that's if we get a big event like the global financial crisis, a big event like the Euro crisis of 2011, or a big event like the COVID crash where everyone is just panicking, or a big event like when the S&P 500 goes down 40% and everyone's panicking into the dollar, into the safe haven. So absent those kind of crisis situations, I don't see the dollar strengthening.
No, I think that's well said, and I'm seeing the same thing just looking at the global macro landscape. So it's kind of looking at the global macro, looking at the fundamentals. It all looks very similar and kind of grim for the dollar at some point. And I think it's one of those situations too where everybody thinks something's going to be this way. Think of, we always talk about the energy stocks being the leader after Biden became the president. It's the same thing when people said, Bitcoin is going to do really well under Trump this time. And it's like, well, why did it do really well when Biden got elected too? It's just when everybody thinks they know something, I think that's when it's going to change. And so for me, there's too many people going, it has to be a strong dollar. This is a perfect strong dollar environment. And I don't think even Trump wants a strong dollar. Like, I don't think that's even beneficial to the United States at the moment. So I think there's a lot of reasons to be a little bit bearish on the dollar. So we'll end on this. I have to leave a little early today, so we got just about 5 more minutes, not even. So I wanted to ask you about the Fed. What I'm seeing and what I continue to see is this massive move higher in rates, the 2-year yield especially. And that started, as you know, on the Fed Day. Fed Day, September, basically rates bottom started moving up the same exact day that they started to cut rates. So what are we thinking here for the Fed? Do you think the Fed's going to have to stop? I mean, to me, we're 50 basis points. At this point, we're 50 basis points away from the 2-year yield. Do you think they're going to cut more, 1-2 cuts, or more?
I believe they have to cut because otherwise it just looks too political, and then Donald Trump can just fire Powell for cause because he did 50 basis points just to get Biden reelected, and then he had to do 25 basis points after the election so as not to look political. But after that, he's just backflipped and said rates are fine and we are not going to cut, and the economy, whatever, whatever. So this kind of backflip, especially the kind of belligerence that the Fed has uh, exhibited earlier when Trump was president. So Janet Yellen, if you remember, right after the election results were announced, she hiked rates by 25 basis points. And it just looked like it was done out of spite because there was absolutely no earthly reason to do it that way. It was not communicated. She just did it. And we all know that most of these bureaucrats, most of the Fed governors, they all lean Democrat. So if they don't cut, it's just going to send such a bad signal that we may actually see something in Congress about reining in the Fed. So I think they have to cut. And I have a different explanation for why I think the yields are rising. So today I came across an article which talked about a bank called a Norichukin Bank. I'm not sure if I'm pronouncing that right, but it's one of Japan's largest institutional investors. And they announced that they're going to exit about 10 trillion yen worth of their foreign bond holdings and take around a 15 to 20% loss on that, and they don't mind taking that loss. They just want to get out. And that just talks about it's the effect of the strong dollar. So the dollar is so strong, the yen is so weak. They would rather just sell their treasuries and recycle the capital back into Japan, into the yen. Now you multiply this effect with every other institution which is holding US debt with the dollar so strong, and what you get is rising yields. Now, are these yields going to rise forever, or are they going to drop once these banks are done selling? You don't know how it plays out. If it plays out in a way that yields keep rising, even if the Fed is cutting rates, then the Fed is going to have to come back and do QE. And right now, the Fed is also selling bonds, so they are adding supply to the market as well. So in my mind, the way this plays out is we see curve steepening, wherein the 2 year probably gets close to the Fed funds or around there, and the 10 year, the 30 year, they start pricing in both an inflation premium and a risk premium. So maybe the 10 year goes to 5%, 6%, the 30 year goes to 8%, and the 2 year stays close to the Fed funds. And what happens is investors rotate out of long duration bonds and into short duration bonds. I think we might see something of that sort happen. And because we're talking about bonds, I know you have to go. Like, just one last point. Saudi Arabia recently made the news, and not for any of the reasons you would think of. It's because China decided to issue USD denominated bonds in Saudi Arabia. Now, I'm not sure if it made the news there, but it was something that's pretty shocking to everyone else, because the fact that they would choose Saudi instead of, say, a European country or a more palatable American ally, that just tells you something. And I think the bond market is also digesting those signals.
No, I like that. And yeah, I heard about that news, but it's not anywhere in the United States media at the moment. So it's going to be an interesting time. A lot to talk about next week. So please subscribe to or please follow the speakers. Kashap has a really great page. Check him out on Twitter. You can find all of his links there in his bio. As for myself, if you guys are on YouTube, you guys can check the description. There's a sign up link on there. Feel free. We put out free reports every Friday. One will come out today. So, all right, guys. Thank you guys for joining us. We'll see you guys next week.
Thanks, everyone. Thanks, Jason.